Hi, my name is Mark and I teach economics. In this video, we're going to take a look at Occam's Razor applied to the stock market. William Occam was a Franciscan friar in the 14th century that postulated that the simplest explanation usually was closer to the truth. That is, when you add on a lot of assumptions and you make your model more elaborate, it's usually just trying to justify the last paradigm. So what does this mean in terms of the stock market? We're going to try to construct a very simplistic model to look at the market to see if it's overvalued or undervalued. And you can use this anytime, at any point in time in the market. Now, this is not a predictive model. It's not a very well fit model. It's a very crude model, and it's not to be construed as investment advice. It's not looking at turning points. It's not using sophisticated computers. But what it does do is give you an example of how to analyze and just at a high level look where the market is in relation to the trend. The trend is your friend. The trend tells you and guides you. And in this case, we're going to use time series data from the Federal Reserve, from the Federal Reserve Bank of St. Louis. The first one we want to look at is we're going to use a program called Gretel. It's a open source program available on Windows, Mac, and Linux. So anybody can access this, and you don't have to be a statistical wizard. I already downloaded the data, and I've got NASDAQ and Dow. And what we're going to do is we're going to add a simple variable here called time trend. This will be the time trend because we're going to use time series data to analyze this. We'll use ordinary least squares as the model. We'll first run the Dow against the time trend. You can see the constant is in there. And we'll create a model. This is model 1. If you look at the adjusted R squared, it's pretty high. You want a high R squared, close to 1. And this is very characteristic of time series data. Not necessarily the best model, and I know statisticians will be rolling their eyes, but listen, this is, again, Occam's Razor applied to the stock market as we see it today. We go to graph, and we fit this actual versus fitted, and it creates a nice graph. You can see these scatter points. We might want to take actual fitted against time. So here's the graph, and this is the trend. This is where we are currently. Even with a correction, we are well above the trend line being a many-decade trend that is going up. The market generally goes up because the economy is growing, and the market mirrors the economy. However, in certain times, it may be above the trend and below the trend. Right here, we see the dot-com bubble. And here again, the mania of the 2008 bubble here. Now, if you were to be sitting in 2008 and run this regression, the trend and the relationship would look different, but we understand that. But look at how far above this long-term trend we are right now, even with corrections. Again, this is not a predictive model. You can't look at turning points. You can't say, okay, now we've made this and now we should invest because there's great valuations. We're not looking at actual valuations. We're not looking at turning points. We're simply looking at the long-run trend. And what does this trend tell you in relation to the stock market, the Dow Jones Industrial? Is it overvalued or is it undervalued? That's something you have to ask yourself. Let's take a look at the NASDAQ. It's a little bit more telling. We're going to use the same idea, Occam's Razor applied to the NASDAQ. We're going to create a model, ordinary least squares. It tries to minimize the errors in the regression line. We're going to run it against time. Time is already there as the independent variable, the explanatory variable, and NASDAQ, the dependent variable. This time we have more data. And as you can see, the adjusted R square is not as good. It's not that great of a model. But we're still going to run with it. We're going to plot against time the NASDAQ. Take a look at what we see here. We see the dot-com bubble and how high this was, at dizzying highs. We see 2008. And if you were in 2008, this trend would look different. And you just have to think about that. We can go back, but we're not going to do it for this exercise. Look at the relationship of the NASDAQ, and these are the tech companies, the large tech companies that everybody is following and is saying is the new driving force of the economy. These are usually internationally diversified companies that have an effect all throughout the world, a ripple effect. Where is it in relation to the trend line? The blue line is the trend line. Is it higher or lower? That's what you have to ask yourself. And is it higher in relation to historical data? Is it a little bit higher, or is it significantly higher? Now, I'm asking and posing these questions to you because I'm not giving investment advice, and I'm not telling you to base your investment decisions on this. However, if you know the general idea of Occam's Razor is sometimes these very complex models are not going to yield any greater predictive strength. And the reason that is happening is because the stock market, although it's not a zero-sum game, it's just not, it's similar to the game of chess. It's just not what white does, it's what black does. Let's say there are only two players in the market and they're both using the highest level of artificial intelligence against each other to predict the market, they're going to cancel each other out. It's like similar in chess. If you've got two AIs playing each other, it's not going to be a quick, easy, obvious win. It's going to be a long, drawn-out battle because it's just not what white does, it's what black does. So similarly in the stock market, sometimes when you apply these very sophisticated models, they start to lose their value when the rest of the market is using these models. Everybody's looking for a turning point. Everybody's looking for a technical indicator that is going to give you the secret to make money and to profit from this. I'm not giving you that. I'm just saying the trend is the blue line, not even a moving average, and this is the NASDAQ. You make your own decisions. So that's Occam's Razor applied to NASDAQ and Occam's Razor applied to the Dow Jones Industrial. It's a simple trend line, and I hope you'd enjoy this video. Subscribe, and I'll have more videos about this. We can even further go into the whys, why this might be happening, and a deeper meaning behind this. Thank you very much.